we're officially live on YouTube for the Thursday edition of the Not Your Average Investor Show, the JWB I am your host, Pablo Gonzalez. With me, the man that I affectionately like to call GC, because he's got the genius concepts, because he knows how to generate cash flows, not today, but tomorrow, and because he's a great co-host, and his name is Gregg Cohen. Say hello, Gregg.
The crowd goes wild.
I was listening to a podcast about Moneyball and like thinking about baseball and all this stuff. Such a good book. And MTM, because she brings us the moments that matter, and because her name is Madison the Magnificent. Say hello, Madison.
Hi.
Good to have you all here. Good to have you. If you're watching on YouTube, go to jwbshow.com and just hop right on into this thing. If you are listening to us in the podcast, if you're watching on YouTube later on at some point here in the future, hi from the past, go to nyais.com, because the best experience to watch this, even though we are a podcast and a YouTube channel and a social content channel, the best way to do it is to join us live so you can be part of what, GC?
The roll call.
The roll call, baby. We got Lee, MVP, Bishop checking in the house saying good afternoon, everyone here in the chat. We got our usual leadoff batter coming in second today. John Henning saying good afternoon. We got a not your average investor guest, not your average guest saying hello, JWB fam. It will be a mystery. Who that is.
We love you being
We
here.
love you being here. We got the fairy godmother of the Not Your Average Investor Show community, Jen Filson in the house. We've got our favorite name to say, Aaron O'Neill, into the lights. Good to see you, Aaron. We got Dean Curry. Dean Curry is the early bird from Columbus, Ohio.
Very
Dean,
cool.
Good to have you. We got the man that everybody knows.
No, Run.
Noah Brandari saying hello, everybody. Who else we got? Dean's wishing you a happy belated GC.
Hey,
If you're wondering. We got Leo Faraganan. Faraganan. Saying good morning, all from rainy Bay Area, California. Let's rock. We got Leslie Wilson from Denver in the house. Leslie, great to have you back in here. We got Dwayne Averill saying good afternoon from New York.
Dwayne, I'm pretty sure Dwayne's a client of ours. Dwayne, let me know. Welcome to the show.
Welcome to the show.
Have you here,
Yeah.
and I'm pretty sure you're a client. So double welcome.
Happy to have you, Dwayne. All right, we got Bill Green, my favorite caller, from the mountains of Colorado. Bill Green, welcome back, man. Good that you're making it a little habit over here. I love it. We got Bill Shields saying, Buenas tardes, no sus inversores promedio. Bill, that is
I don't know that one.
that's when Google Translate goes wrong. That's not that it literally you did translate every word there, but it's not the correct way to say it in my tongue. Not your average investor. Inversor. I don't know how to say that. I'll get back to you on that one, Bill Shields. But buenas tardes, Bill Shields. Good to have you here. We got our regular Rosalind Riley saying good morning, everyone from Marietta, California. Good to have you back. Rosalind, we got David Blattner in the house from Massachusetts. I like it, Davey B. That's a good
I
one.
love that one.
Yeah,
There we go.
I like when people give themselves nicknames.
the best.
Not only does it show character, but it also reduces mental burden on me.
Yeah.
And we got Marilyn Cotterman from Homosassa, Florida.
The home of the manatees. bud.
Home of the manatees. Marilyn, good to have you here in the house as always. Oh, we got Ken and Carolyn Moline, who we affectionately call the first family of the Not Your Average Investor Show. We salute you. All right, good stuff.
It's good to be here.
It's good.
It's just good to be here.
It's good to be back in rhythm in the studio, having run twice.
Yeah.
And you know what else is good?
What's that?
My favorite segment of the week.
Mm.
When Madison shares good news.
Hi, everybody. Our good news today is a little bit of an announcement as well. I'm sure you guys might have gotten an email, but the Q4 Jack's real estate market update with yours truly is going to be December 5th for clients only. So your client, super cool opportunity to hop on. The JWB team is going to be live in studio as well. So it'll be super cool, be able to see them, ask all the questions you want, get a little sneak peek into what Gregg is predicting the Jacksonville market to be in 2023, and get an exclusive on how the JWB team has been performing this past year for you. So super cool, super exciting. And if you're not a client, you get the same opportunity the next day. So next week is going to be a really fun week.
Who's ready for a little client only call and real estate market update? I mean, this couldn't come quicker, man. Like, we have to wait 3 months to do this. I'm super excited. Are you excited over there, Madison?
Oh, I'm really excited.
I know that you're ready, buddy.
I'm ready, man.
You've been-
I've been ready. And,
You've been
and
ready.
I think a lot of our audience too is ready, because you guys have been asking a lot of good questions. And I've kind of given you a little bit of a cliffhanger lately. You say, hey, what do you think's going to happen here? What do you think's going to happen here? Part of that's because I've been spending a lot of time thinking about what do I think is going to happen in 2023. And the other part of it is because there's a perfect forum for that. We're going to have all of our clients here. All of our clients are invited. We're going to have a huge presence from our team is going to be there. It's going to be that live studio audience that we've been kind of tinkering with. So
The wild card.
you know, a lot to look forward to on Monday. So check your emails for all of you who are current clients. Can't wait to have you there. And for all of our audience who are not clients yet, we're going to do a little recap on Tuesday. So we're not going to leave you out in the cold.
It is historically our most viewed live show, our most downloaded podcast, our most watched YouTube video. So you know what I call that? I call that good news. Thanks, Madison. Good stuff. All right. So as we go on to the proper, whoa, wait a minute. We got some breaking news. GC, I saw you practicing some breaking news a little earlier. What's going on?
Hot off the press. So that's why we got like an extra 67 beeps out of that one. That was incredible there. We got some really good news. You know, sometimes I have to be the bearer of bad news. We've had some bad news in the economy and the stock market and yada, yada, yada. Well, I'm going to give you some good news today. We're going to get some good news today. And for all of you who have been paying attention to interest rates lately, we had the single largest drop of interest rates in a 1-year period in 41 years. That just happened. In 41 years. What were you doing 41 years ago?
I was 1 year old.
Yeah, I wasn't born yet.
I know. I know. I was waiting for that, young man.
Oh man. So yeah, so this is great. This is a really nice, I don't know, respite.
Little
Right?
bump, man.
Little bump,
Yeah,
right?
a little bumpy.
I don't know that this is going to last. I don't think anybody really understands why this has happened fully. Basically, once the Fed gave once the CPI numbers came down, so inflation came down, everybody has just been very excited about this. And so, you know, there's a number of things that once the CPI comes down, that it indirectly affects a million different things. And it's resulted in, you know, interest rates dropping by about a 0.5 point for our loans and for loans across the board, which is a really, really great thing. So I don't know how long it's going to last. I think there probably is an overreaction to the good news of CPI dropping, because let's be honest, CPI is still 7.7%, incredibly high. And if you listen to the rhetoric from the Fed, it's that, hey, listen, don't overreact to this. We still have a long way to go until we get CPI and inflation down to the 2% level, which is their mandate. So
GC, before we go too crazy on acronyms, what is CPI again?
thank you. I appreciate you. Consumer Price Index.
Consumer Price Index. So how we measure inflation, essentially, how prices are doing relative to last year's prices.
Yeah, exactly. There's a basket of goods that the Fed always measures, and that's how they see how much inflation has affected the economy. They see how much that basket of goods cost last year, and then they run that same basket of goods this year, and that's how they determine the overall inflation rate. And when it's super high like it is, the Fed is going to do things to try to bring that down. One of the things that they have been doing a lot of lately is they have been raising interest rates. So when we get a little bit of better news that CPI is coming down and inflation might be subsiding even the tiniest bit, the market is waiting for any bit of that news. And that's really what's happened here. There may be a little bit of an overreaction. Is kind of a lot of people's feel out there, but let's just appreciate the fact that interest rates today are about a 0.5 point lower than what they were. So for all of you who have been thinking you're on the sidelines and you're like, listen, maybe this is the time, maybe I've got money in the stock market and I'm not excited about the prospects there. I'm thinking about pulling it over and putting it into a rental property portfolio. Today, when you put it under contract, this 0.5 point decrease to interest rates will result in that same rental property producing about 1% higher in return on investment and about $75 a month more in positive cash flow just from this effect. So a big deal.
That's a big deal. It's a big deal.
It's a big deal.
I hear you saying it kind of tempered in the sense of, so right now it may be a window, you know, like if all things I hope that this means that inflation is chilling and we're not going to have to go into like unemployment and all these different things. But I sense a little bit of like tempered excitement there in the sense that, you know, this might be an overreaction because everybody wants to see this news. We just had elections, whatever, right? So people are like hungry to like get good news. I also heard that this Black Friday was the Americans spent more on this Black Friday than ever before.
Yeah, really.
So if we are really following this idea that is inflation going somewhere,
Yeah.
and are people still burning through cash that they don't need to be burning through?
Yeah.
That's kind of I would see why that would temper the expectation that this might be a blip and maybe interest rates go up again. I guess we just don't really know.
I really watch what the Fed is saying. You don't fight the Fed. When the Fed is telling you signals about what is going to happen, you need to listen. And what the Fed is saying is nothing different today versus what they were saying 2 weeks ago, 4 weeks ago, and before that, which is we have a lot of pain to go, that it is going to take a long time to right the ship. Do not get overly excited about this. That is exactly what the Fed is saying. So that's how I feel. And now on the positive side, the Fed has said, we are looking at increasing rates, right? We're looking at increasing rates at a smaller clip going forward. So there is a lot of positive reaction from that, right? The pace that the Fed has raised the interest rates and the borrowing cost has been unprecedented for 40 years. They haven't done it this fast. So now they're talking about it and they're saying, listen, maybe we'll slow that a little bit, but they're still raising, they're going to be raising them for a while. So long way to go. Don't get overly excited about this. And if we think about how this affects you and your investment decisions, enjoy this for now. It's probably not going to be, a direct path to lower interest rates in the future, right? There's a lot of stuff going on. So enjoy it now. Take advantage of it. If you're on the sidelines and you're thinking about getting in, this is a great time.
Good moment.
Yeah. So, So
Bill brings up a good point. He says that he thinks maybe the Black Friday data might just be reflecting the price hikes. That could be true, right? Like if prices have gone up that much, I just kind of think, I don't know, because we've talked about the CPI. What is it, like the real CPI versus the other one? Like there's like two, right? There's like milk and gas and all that stuff, and then there's like the other consumer goods stuff, and they've both gone up. So it could be reflecting that inflation would play a role in the idea that this is by dollar volume, it would by default be higher than last year.
Yeah,
I think it's still something to be said that like, regardless, we've been on record setting Black Fridays for a really, really long time. I feel like that's something I've heard in the last like 4 or 5 years nonstop, right? So
yeah, I think we got a long way to go. And I think, those indicators are good to look at, but I think the real indicators that you need to look at are the labor market, employment, right? Consumer spending, which is a part of Black Friday that we're talking about. But, you got to get consumer spending down. When you get consumer spending in order to get inflation down, you have to get consumer spending down. When you get consumer spending down, companies make less money and they have less need for labor. So then job losses are likely to come.
Correct.
So I don't think anything is really changing based on this data. I mean, if there's one thing we as a society do pretty darn well is we overreact to news. This largely feels like, probably an overreaction to see interest rates drop a 0.5 point in a week, but we're going to enjoy it while it lasts.
Got it. So the moral of the story is here. Good news, enjoy it.
Yeah.
Don't overreact.
Yeah.
All this means is that right now there's an extra 1% returns.
And we're going to enjoy it. We're going to enjoy the hell out of it.
And we're going to enjoy it right now when we magically whisk ourselves away to, GC, do you have a sore throat by any chance?
No,
because we are right now going to, how do I find this thing? 1255 Bangola Drive, Jacksonville, Florida, 32205. I saw that thing. I was like, it sounds like Ricola.
Yeah.
1255 Pangola. I don't know. I don't write these addresses. Pangola Drive, Jacksonville, Florida, 32205. Beautiful little property here. Purchase price of $242,000. Monthly rent of $1,536. 3-bedroom, 2.5 bathroom, 1,509 square feet. It is fully finished. It's got a 3-year lease on it. It's benefiting from that beautiful annual appreciation rate here in Jacksonville of 4.6% for a full market cycle. And it's got this thing here that is what we're actually all buying is this IRR of 12.3%. GC, What do you love about this property?
Thought you'd never ask. I'll tell you what I love about this property. This concept of doing these three things when you're looking about what you are going to do with your investment dollars is critical. If you can understand these three things are the things that you need when you're thinking about making an investment, you're going to do really well as you're going into recessionary times likely, and as you're dealing with high inflation as we all are right now. Number one, the investment decision you make needs to beat inflation. When I say beat inflation, that means that it needs to be a higher return than the CPI. The CPI currently is 7.7%. So if you're looking at an investment alternative, it needs to be higher than 7.7%, or else you're not really earning anything on it. So when you look here, one of the reasons I love this property is because you're looking at your rate of return, your internal rate of return, which is 12.3%. Is that higher than 7.7?
Yeah, that's
Check.
higher. Check.
We did the first one. You know, the second one is, are you mitigating risk here? Now, most people, when they, you know, go after a return on investment, call it 10%, you know, maybe higher than that, they think to themselves, well, what do I need to risk to get there? Am I speculating, you know, because a 10% return is tough, or a 12% return, it's just not easy to do these things. You usually have to take an outsized amount of risk. Well, for an investment like here on Pangola, I used to call it Pangola, but now it's Pangola.
I don't know. When I read stuff that isn't in English,
Yeah.
I read it in Spanish. So I don't know. Pangola is where I went.
When I look at that, I think of risk mitigation, because this is an asset that is producing positive cash flow. It is paying you 5 ways, and that's risk mitigation. You don't have to take a lot of outsized risk. And then the last thing is that this is an investment that needs to be passive, right? There's only so much work that you can do during the work week. You know, you have to figure out a way for your dollars to work passively for you. So these 3 things are so important. This is the reason that I love this property, though. Number one, it's beating inflation. IRRs are above 7.7%. They're actually 12.3. Number 2, there's risk mitigation built in. It's positively cash flow and paying you 5 ways. And number 3, it's passive. And the key to passivity is to work with the right team, which is, of course, you're working with my team. So we've got that squared away. And then lastly here, you know, when we make these return estimates, they should really matter for people if they're thinking about putting their money there. And the best way I know to show you that we can take care of your money is by that little stat there down at the bottom. Been in business for 17 years.
This one down here?
Yeah. Sold over 2,800 rental properties. 100% of those properties have outperformed their expectations. So we'll do that same thing for you.
That's pretty crazy. So caveat on that is if you've had it for more than a year,
Yes.
within the JWB, in order for that data to mature.
Thank you.
But still pretty baller, dude.
Yeah.
Pretty baller. So I look at this property, it looks like one of these homes that JWB builds in one of these floor plans. That's like an existing lot. Is this a new construction here? This kind of like tall but thin thing that you're doing in an info lot?
This was actually built in 2018.
2018.
Mm-hmm.
Okay. So, but looks like y'all built it.
We did. Yes. We built that.
Cool.
One.
So this is one of those like existing, but it's basically new construction kind of.
Yeah. The way we would differentiate new construction versus renovation is anything that's built after 2014 for us has fallen into that category of slightly lower maintenance and vacancy cost. And so, yeah, we would call this new construction, although it's not technically brand new.
Tell me about that. Let's talk about the data flywheel here.
You haven't mentioned that in like 2 minutes.
I haven't shout out to Tara. Talk to me about that, right? So you look at, I know that we've talked about how, because JWB operates 4,600 plus properties all in the same area, all of your numbers come from real life data from, you know, one-to-one examples of what you got going on. We've talked about the fact that maintenance rates for new construction are different than renovations as a result, but it sounds like you also have another caveat, right? Like something that is a renovation versus new construction, brand new is one, but there's also another bucket of kind of like lower maintenance if it's built in since 2014. Is that what you're talking about?
No, not really.
Okay.
So
way off.
Well, you're close. I mean, I understand why you would think that. I probably didn't explain it very well. So you've got 2 buckets, right? And the same 2 buckets that you guys have seen on all of our property evaluations, right? For new construction properties, you're going to have an expected maintenance percentage of 4%. So that means every year you should plan that you're going to give about 4% of the rents that you collect back in terms of maintenance costs. Doesn't happen every single year. Some are more than less in terms of years, but over time, it's going to average to about 4%. And that's based on all of that data. Now, that 4% number has been looking at all of those rental properties that we have sold to clients and we continue to manage that were built in the year 2014 and later. So we just define new construction starting at the year 2014 and later, because largely we started to go very strong in building new construction in the year 2014. So that's when we sort of had enough data to be able to see a real difference in terms of maintenance and vacancy cost. And then from then on, you know, that data hasn't really changed much, meaning like the maintenance costs have been largely similar for everything from that point forward. So anything before 2014, so 2013 and earlier, is our renovations budget, meaning that for an expected maintenance number for anything that's built in 2013 or before, you'll see 7.5% for your expected maintenance cost, because properties that are a little bit older tend to break a little bit more, right? And you would expect that, I would imagine. So you're going to see about 7.5% of your rents collected, you're going to give back in the form of maintenance cost over the long haul. So it's just a delineation, really.
Got it. If I am looking at properties somewhere else, right? Like, let's say I'm looking in a different market, so I'm not going with JWB. Can I still use that? Can I still use that kind of like assumption of 2014 caveat versus new construction or reno, anything like that?
No, unfortunately you can't. I mean, there is so much that goes into the maintenance and vacancy expectation. It is so critical for you to get a real number on that. It can largely shift you from being cash flow positive to cash flow negative. It could shift your overall return on investment from 12.3%, like we're talking about here. If I put a number out there that wasn't really backed by data, like a lot of other turnkey companies do, I could put much lower expected maintenance cost, and that would jack up your expected return on investment. It might be 15%, right? But ultimately what happens many times is that those costs actually come in higher than those other companies represent, and the real returns come in much lower. So long story short, this is the key to working with a provider, is that they need to know their numbers. They need to be in business long enough to actually have a data flywheel. They need to care enough about producing returns on investment that they know their numbers. And you can't just take one other provider's numbers and apply it to another provider. You know, I haven't seen any other providers that actually track data like we do. And I definitely haven't seen anybody hit our numbers for low maintenance and low vacancy costs. And I've done the research, what I see often is one of two things. Either they just use an industry average, which industry average might be, 5 or 7%. Usually they go to 5% because it's in their best interest to have a lower maintenance percentage. So they either go way low and it's just based on nothing, or they just flat out lie about it. They know that their maintenance numbers are higher and they just choose to not report it because it would decrease their ability to sell. I see it all the time.
Wow. Okay. So what I'm hearing there is, number one, if you're going to buy a rental property that you're not going to manage, right? If you're investing passively, you need to find a property manager that has their own data set, or else they're just numbers on a board that you really can't count on.
Right.
And then the other thing that I heard in there that I was able to pick it up because I was telling you, I was educating my cousin about this stuff a couple of days ago. He was looking to invest in either, right? He's an entrepreneur and his business is doing real well. And he lives in California. So he's getting beat up on taxes.
Yeah.
So he's looking to put some money into real estate, and he was going to take a course from this dude that looks like he's like 14 years old, probably in his like 20s or something. And I'm like, how long has this guy been a businessman? And like, I looked him up and I'm like, this guy looks like he's been doing real estate for about 7 years.
Yeah.
You basically just said, right. And I told that story because I think it really matters. What I told him, I was like, listen, man, I don't know how much I would want to invest in or trust somebody that hasn't been around for a full market cycle.
Yeah.
Right. So like this idea that it's like somebody that has their own data, and the data has been proven for a downturn and an upturn and a full market cycle, I feel like is like an underrated piece of advice of who you want to do business with, whether it's in Jacksonville or Cincinnati or whatever.
I think it really helps. I think it really helps. The experience of going through and having 40 rental properties in 2006 and to know what it really feels like when you go through a unprecedented market drop and to still own those properties and to have acquired more and to know how to win no matter what market cycle is thrown at you is really important. I won't say it's the only thing you can do. I mean, because, I was telling people to invest with me, after I was 1 year in or 2 years in or 3 years in. So I think it really helps to have experience, and it's a lot, it's nice that we have that ability to sing that from the rooftops now. If you're thinking about investing with somebody else, I just think you have to if they don't have experience, they just need to wow you in other ways. I think the character of that individual that you're investing with is paramount. I think that their investing strategy just has to make complete sense. You got to go and, you just got to do a lot more due diligence if they don't, would be my suggestion there.
Makes sense, man. Makes sense. All right. Leslie said in the chat a little while earlier, is this a flat roof? It looks like it's a flat roof from here on out. Do y'all build flat roofs? No, we don't build flat roofs. Although it does look that way. It's not a flat roof. Not a flat roof. All right, cool. Because Leslie was saying that she doesn't like flat roofs. Yeah, I wouldn't either. It wouldn't make much sense. No, there's roofs that just have a low pitch, and that's all this is. That's what I figured. Usually in Florida, we have a lot of these low pitch roofs, right? Why don't you like flat roofs? Well, I mean, it would lead to roof. If you literally just had a flat roof, it would lead to roof issues because there would be no runoff for the water and debris and all that other stuff. So that's what she put in there too. It's got like it leads to like sneaky leak situations. Yeah. Sneaky leaky. Yeah. Is what she said. I guess you have seen that for houses that were built a long time ago. Yeah. We've bought houses that had like close to a flat roof, and then we had to do roof work to make sure that wasn't an issue. But you wouldn't build a house in 2018 with a flat roof. It's just kind of looks that way. Speaking of 2018, Lee MVP Bishop says, Gregg, was this property part of your team's investment portfolio that was released? Why was it built in 2018 and selling now? I don't know. I didn't look it up ahead of time. I saw this here and I was like, oh yeah, 2018, I should probably know. I don't know. I'm happy to answer that question later on. If you want to put it in the Facebook group, I'll go in the Facebook group later and I'll tell you how. Cool. That works for me, man. Bill Green's got a question. Since he is from beautiful Colorado, he's asking, do you guys pay more for insurance there due to hurricanes? Great question. For new construction properties, and a 2018 property would fall right in line with this delineation of new construction. Your property insurance costs, your premiums each year are incredibly low, right? So I've got the numbers here. The insurance on this property, the annual premium, $536. $536. It's lower than I would have thought. Yeah, absolutely. And that is because it's new construction or built in 2018, right? After, a certain year, the building codes became so much stronger. And so insurance companies look at homes that are built after that year. I think it was like early 2000s or whenever, and they've seen much less loss there. So they require much less premiums. Now, on the flip side, if you own a home that is a renovated home, just like you do, right? You're paying a higher insurance cost per the market value of the property. Correct. Right? Your insurance might be $1,000 a year, right? Somewhere on there. And you paid less than $242,000 for that property. I did for all three of my properties. Yeah. Correct. So your cost of insurance are higher when you own a renovated home, but your purchase price is lower. Your rents compared to your purchase price are higher. And so it all evens out in the end as far as delivering properties that are positively cash flowing and still getting you right to that, call it 11, 12% return on investment. But one of the ways to win for new construction properties is definitely a lower maintenance cost, but definitely lower insurance costs. Got it. So it all kind of, what we've learned here is that it all kind of evens out. And at the end of the day, these numbers that you're putting on these slides that summarize the investment sheet has everything cooked into it. But in that cooking, it is the, lower insurance rates and lower maintenance costs for new construction versus higher price of the home to the renovated properties that have lower prices, slightly higher maintenance, slightly higher insurance and stuff like that. But the returns are all in this same ballpark of IRRs for the whole portfolio because you see these homes as widgets. I do. I am agnostic between new construction or renovations because my outlook is long-term, as I would suggest yours is too. And guess what?
New construction properties, when you hold on to them for 20 years, like I've held on for mine, they're not new construction anymore.
That's right.
Eventually, they will all be non-new construction.
There you go. Martin Kazmarek. I hope I'm pronouncing that right. Matt Martin, new name?
New name.
New name?
New name.
Welcome to the show, Martin. I'm glad you checked in. All right. Martin's asking, Martin went to jwbinventory.com or took the link that Madison shared in the chat, downloaded the property eval, so has dove in a little bit deeper and is asking, just wondering if the 5.88% interest rate on the conventional financing is real per the analysis sheet.
Martin, fantastic question. And absolutely that is real. And that is the interest rate that I expect you to be able to get when you put this property under contract. The reason I'm so confident in that is because we work with a very select group of approved lenders. We are so in tune with our lenders. Every single week, they report their interest rates to us. And so this is not just a pie in the sky interest rate number. This has been verified. Clients who are going under contract right now are getting that interest rate. And the cool thing is that, a week ago, it didn't say 5.88.
That's right.
It said 6.5 or something like that.
Mhm.
Right. So you're seeing the big, opportunity right now. And absolutely that's real.
Let's talk about that, GC, because I think that always ends up coming up, right? Like, can I bring my own mortgage lender? Do I have to go with you guys? Are you making money on the mortgage?
Yeah.
Tell me a little bit about the philosophy of the mortgage lender, because I was trying to explain that to my cousin a couple of days ago too.
Yeah. We are absolutely determined to give you the best risk-adjusted return on investment. And so, but, there are some things that we restrict. And one of the things that we restrict in order to be able to do business with us is that you need to work with a lender that is in our approved network. And one of the early questions we get is, do you do that because you get a referral fee? The answer is absolutely no. And, we have been approached to receive referral fees all the time. Lenders bend over backwards and say, I will pay you this referral fee over and over and over again. And we have consistently said no, so that I could sit here with you all and tell you that I really, really, really am going to put you with the best lender possible. You might ask, well, why do you have to restrict this? Why do I have to work with one of your lenders? You might say, well, listen, I have a lender friend who just got me an interest rate of 5.5% and yada, yada, yada. I want to use them. What we have seen in our experience is that the loan that you need here for a turnkey rental property in Jacksonville, Florida, is very different than a typical, what I would call vanilla loan in any other part of the country. You have to work with a lending team that is very specific and has experience closing this type of loan. Otherwise, what you do is you end up wasting a whole lot of time for yourself and money for yourself and for JWB too, a whole lot of wasted time, because many times you'll go down the path with somebody who doesn't have experience doing this loan. You'll spend lots of time, waste lots of energy putting all these documents together. You'll spend 30 days, 45 days, get to the finish line, and guess what? You won't close the loan. So, our lenders, and there's a whole lot of rules that banks just don't tell you when you start a loan, because the underwriter is not somebody you talk to when you get the loan. You're talking to the loan originator, not the decision maker. And there's a billion rules that banks have, and some of them don't work with turnkey rental properties in Jacksonville, Florida. So it is truly something that we do not make any money on as far as that. And it is all about it's about closing the loan, number one, which is important for you, but it's also important for JWB. That's the vast majority of our income is counting on home sales that actually close. So it would be irresponsible if we couldn't actually confirm that the loans would go through. And then it's a lot of just trying to create a great experience for you. It is not a good experience to work with a new lender who hasn't closed a loan before. And you don't have to risk that when you come with one of our lenders.
So a couple of Pablo's perspective on this.
Yeah.
Number one, as somebody that is a fanatical networker and a connector, I love the approach of no referral fees,
Yeah.
right? Like I get asked about that all the time. Like, even if I give somebody business, which I often do because I'm a connector, and they're like, you want me to break yourself off? I'm like, no, man, I really don't, because I don't ever want to recommend something to somebody that is in my best interest. I want to recommend something to somebody in their best interest.
Right.
If not, it cheapens it. Right.
Right.
And I lose my cool guy status in your eye, which is what I play for.
There you go. You do it quite well.
Right. So I like that, man. I really like that. I like that policy, even though obviously there's money on the table for y'all. It's the understanding that your reputation, your brand, your name out there in the market is way more valuable.
Yeah.
And you don't want to set up different incentives that could risk that.
Yep.
Second, I've just been in the process of getting a loan for my business.
Yeah.
And boy, when you say that the originator and the underwriter are different people,
Yeah.
that is so real, man.
Sucks,
like
man.
I have literally been like trying to get, I went one path. This guy's a Bank of America guy, right?
Yeah.
Like, so like, Bank of America.
You would think.
Yeah, you would think. And he's like, yeah, we're going to get you this loan. It's for this, not a line of credit, and you're going to be able to do it. I went down the path, talked to the underwriter. Underwriter's like, no, it's only a line of credit. I can only do this much, blah, 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 blah. Ended up getting timed out. I had to go back in and get another credit check because now we had to go for the other product. And he was like, this time you're going to get the loan. It's not going to be a line of credit. This one is real. Went into it again. Nope. Line of credit again. Same exact terms. For no reason. I just went through the same process twice. It hit my credit report twice to get checked on, and just a terrible experience. So I could see why when you say that the originator and no matter if it's your buddy that's closing it, you got to have the experience of the person that knows how to close a particular thing, or else it's not going to work.
100%. It just, you just got to do what you say you're going to do. And, that's what we are trying to do. Removing the variables to doing what we say we're going to do is what we're trying to do there.
Yeah. Yeah. All right, cool, man. Well, we got my boy, Jag Chatta. Jag is
you did this last time.
Milady Jag. Yeah. Sorry, Jag.
Raj Bantu is your partner.
Yeah. Man, it's one syllable. Listen, as somebody who gets called Pedro and Paco all the time, I apologize for that, Jag. Jag, I'm happy to have you back on the show. I don't have a lot of practice saying your name because you haven't been in a little while. So our friend Jag Chatta, she asks, there are companies in Florida that are now building to withstand hurricane force winds, et cetera. Is JWB doing that as well?
Yeah. I mean, the building codes require that, and so we're able to build to those codes. The cool thing is that, in order to do that in other parts of Florida, like in South Florida, you got to build like concrete block, right? In other places, right? You don't have to do that in Jacksonville. And so you can build wood frame houses, which if you think macro about this, the ability to build wood frame houses that can meet code and withstand the hurricane force winds that you're talking about allows all of us to be able to spend less to buy properties. You just can't do that at the same rate, the same way in other parts of the state or other parts of the country. And so if you think macro about it, this allows our cost basis to be lower, allows us to earn that same amount of rental income for a cost basis, allows us to produce positive cash flow. So there you go.
Jack, what I can tell you is coming from my background in construction, right? Like for a long time after Hurricane Andrew hit in 93, the state of Florida went really, really hard at figuring out what is the code to be able to withstand hurricane properties. And they've really nailed that thing.
Yeah.
So much that by like 2003, 2004, they really stopped worrying about it so much because the property stock that's been built since then performed so well. And they've started focusing on energy efficiency more than that, which I think is a good thing. But yeah, I agree. As somebody that's built a bunch of homes in Florida, in different parts of Florida, homes that are being built post 2004 are all, really, really good against hurricanes.
Yeah.
And it's surprisingly easier than you think. It's really like a couple of extra nails and an extra trust here or there.
A lot of time and energy to figure out how to do it.
Yeah.
In a cost efficient manner.
Yeah. There you go. All right.
I was going to say, I built my own home in 2018.
Yeah.
Wood frame. I live pretty close to the water too.
You live pretty close to the water.
Wood frame.
Yeah.
So that's very normal here.
Cool. I'll have you know that a couple of breaking news here in the chat. Ken Moline, the patriarch of the first family, his iPad is jinxed, but he finally got it on into the Net Travelers Investor Show.
He won't be denied.
He will not be denied. Ken, we really appreciate you working through that jinx on Tuesday to be on the show as the star that you are.
Man, that was awesome.
And Lee, the MVP, says he officially has posted the question in the Facebook group. If you're not in the Facebook group, Madison shared a link to it in the chat, but you can also go to jwbfacebookgroup.com and it'll hot link you right into that thing. So hope that we get some new folks in the Facebook group. We love hanging out with you. Gerard Wendling. Gerard, welcome back to the show, buddy. Asks, any idea what the non-recourse rate is these days?
Yeah, there have been some updates to non-recourse rates, as you would imagine, with the Fed raising interest rates the way they have, all other rates would be going up. So non-recourse rates have gone up just like other interest rates have. Somewhere in the 9% range for non-interest or for non-recourse debt. And for anybody who's kind of not sure what non-recourse debt means,
That means that Gerard's asking about buying properties in his retirement account. And when you buy properties in your retirement account, which you can totally do, by the way, many people think you can't do that. You totally can. We have literally hundreds of clients who have done that. If you want to get a loan, you have to get a special type of loan. It's called a non-recourse loan, and it's completely different than a conventionally financed loan. So somewhere around 9%. Some of the other terms have changed. Gerard, I would encourage you to reach out to your portfolio manager. I know you're a client, so reach out to your portfolio manager, and we're happy to give you an update on the non-recourse terms.
Got it. All right. Lee Bishop's got a technical question. I think we're gonna dive into the spreadsheet here because Lee is asking, Gregg, you said there is positive cash flow on this property, but the spreadsheet says you make money on the second year? Question mark.
I love it. I think it goes down to like, what is the definition of positive cash flow, right? Because in a rental property, there are going to be some years that are not cash flow positive, even though the property is performing. And that would be years when you have things like a tenant placement fee, right? A tenant placement fee is what you pay in the first year on. Cool, we're bringing it up. So a tenant placement fee you pay in, let's say, the first year when the home is rented. Well, you know what? That's going to take money directly out of that positive cash flow. So like, I think what Lee's asking is, well, Gregg, what is the real definition of positive cash flow? And the definition of positive cash flow should be over a 10-year period of time. And if you want to kind of like zoom out over those 10 years, I'll show you kind of like what I'm showing you here. Over a 10-year period of time, your cash flow should be positive, right? It is just a natural part of this. In some years, when you have a big expense like a tenant placement fee, that it's going to be negative in that year. And so that's largely what you see in the first year and in the first few years, actually. But over time, what happens is your rents continue to go up. You don't have those same expenses every single year. You don't have a tenant placement fee every single year. And so over a 10-year cycle, you want to make sure that number is positive on the cash flow side. So Pablo, if you would go to zoom in there and go to see that negative 1944.
So this is rental income.
Rental income.
Right.
So if you go to the spreadsheet here and you look at net rental income, you're going to see in the first year that it's negative 1944. Well, what you also see is you have $1,536 worth of costs in the first year, and that's coming from your tenant placement fee. You don't have that until year 5 again, because JWB's rental strategy is to have residents that stay long-term. That's why we sign long-term leases, right? Over time, your rents will continue to go up. You'll be cash flow negative for the first few years. But if you take the average of, or the sum of all of those net rental income numbers over a 10-year period of time, you're going to find that it's positive. And so that really should be your definition of what positive cash flow is. So there you go.
What about the idea of like monthly positive cash flow? Isn't that what we talk about as far as like scalability? Isn't it monthly positive cash flow month one?
Yes, it is. So there's a couple things to think about, right?
Okay.
Now, if you're thinking about net rental income, including all expenses, right, including your tenant placement fees, including your lease renewal fees, things of that nature, you do want that to be positive over a 10-year period. But there's another way to look at it as well, which is more relative to what happens on a normal month. So I'm really glad you brought that up. The way that you would kind of differentiate this is kind of, you can see there's expenses that are recurring and then there's expenses that are periodic. So on the monthly basis, you want to look at what's recurring every single month. What's for a normal month? And is that positive? Well, what you do is you go up there and you see, and this is probably what Lee was actually referring to now that I can kind of see it.
Yeah,
right?
he said line 29. So
yeah, exactly.
Yeah.
So we've always, we have reflected your monthly basis. We've looked at year 2 because that's when things start to normalize. Year 1's a little, you got some costs, right?
Yep.
You got tenant placement fees. So if you're trying to compare kind of like the way that we have always defined monthly cash flow, we've always reflected year 2 specifically on the recurring items. If you're looking even bigger picture and you want to see how it's performing, including all of the costs that come along with it as well, that are like periodic costs, then you want to be positive over a 10-year scale. So I think both of those is kind of how you want to do it.
got it. Cool. That was a good one. That's why they call him the MVP.
There you go.
All right. GC, I think that was a good little PLT dubs.
Yeah.
And I think we got some good questions. Love some new interactions. We got some folks back that haven't been here and some new folks. Thought that was a bunch of fun. I'm really looking forward to Monday, the investor only call,
right,
and then Tuesday's recap of that on the show, man. I know you've been working hard at this, man. Any teaser about this of like what we're talking about? I know I'm putting you on the spot.
Man, how much do I share without giving away the house here? I want people to actually show up on Monday. I really think that there's so much that you can do going into a recession to invest wisely. And I think there are so many misconceptions. People feel like you have to be a victim in a sense when you're going into a recession, right? Like that all of this is happening to me, that, that the money that I have, I should just expect it to be less. And, if there's anything that I want to empower all of us to feel, especially coming out of this call on Monday, is that you don't have to be a victim. You don't have to go into a recession and think that your income or your wealth, it has to take a hit. It starts with great data. It continues on with great perspective. And, that's what I really hope to bring. So I'm going to be here to field all of the tough questions that you guys are going to bring, right? What are home prices going to do in the near future, right? What are rents going to do in the near future, right? All of those questions, this is the moment for us to dig in. I'm going to do my best to have some research prepared for you all. And then it's going to be, a great opportunity for us to chat about the positives and the negatives. It's not all going to be positive, right? Yeah. There's going to be some negatives we're going to talk about. So
you have referred to it as the most important client update call to me multiple times. I feel like you're coming in hot on this one.
I go back to March of 2020 when the pandemic hit, and I have the same sense of how important it is to help our clients look into next year as it was in March of 2020. And I think that same sense of like, what do I know? What do I not know is what I think is going to guide this call. It's a very tough time to predict what's going to be happening in the economy and the investing world and in real estate. It's probably the toughest time since March of 2020. So I think it's just a really important opportunity for us to lead with transparency, to help inform you to make the best decisions with your money. And I think overwhelmingly, we're going to leave empowered from that call. That's what I hope.
Two last questions. Milady Jag Chada asks, any update from John Burns? Well, Jag, I'll let you know that Gregg was literally just looking over John Burns' data right before this call, getting ready for it. So
me and John are tight. He's in my ear all the time,
JB.
actually. Yeah. And a lot of what I'm using as far as data to prepare for Monday's call is coming from John, as well as a few other sources. So we'll talk a lot about what John thinks and what we think as well. So.
All right. Bill Green sneaking one in. Can you recommend a good website or app to track interest rate changes? Not yet.
No.
Facebook group.
No. I mean, I usually go to, for me, I'm not looking real time. We get our real time data from our lenders. I look at the Freddie Mac, 30-year mortgage average interest rates. So that's not real time. So I don't have anything for you. Maybe somebody in the group has a good suggestion, or in the Facebook group, I would really recommend you post something there. I'm sure one of our 3,800 savvy, not your average investors can help you there.
Got it. Somebody did put in there. A not your average investor said bankrate.com.
There you go.
Is one. Also, Bill Green and Lee Bishop want to know, will there be ice cream?
The ice cream. I think that's a really good idea.
That's a good idea.
I think especially for our next Not Your Average Investor meetup, which is coming.
I'm assuming there's going to be ice cream for that based on the location.
Well, I know that they'll both be there.
Yeah.
So if we, do a little ice cream, I think we'll sweeten the pot, and I know they'll both be there. So we'll see what we can do.
Love that. When is that? We're still locking that in, Lee. We'll announce that when it's ready for prime time. Beyond that, I'm really looking forward to seeing everybody on Tuesday. I'm beyond grateful that we've had so many folks. We've had like about 40 people just hanging out with us. I know it's a Thursday, middle of the workday. Never, ever, 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 ever take it for granted that you're taking time to hang out with us here, asking great questions, making it easy for me to moderate, letting me know when the audio is not working. Huge. So just really appreciate you all. And GC, I think you can say goodbye to everybody.
Thank you. Thank you. I think I will say goodbye to everybody. Bye, everybody. See you later.
All right. We'll see you on Tuesday for the recap of the client only call. And I promise you, it will not be your average recap. See ya.